Hey everyone, welcome back to Corporate Decoder, the place where we dig into the world of business. Today, we're cracking open PRA Group's latest annual report, and let me tell you, this one's a real roller coaster. We're talking about debt collectors, so things are bound to get a little messy, right? PRA Group, in its simplest form, buys up debts that other companies have given up on. They purchase these debts for pennies on the dollar, then try to collect as much as they can. It's a high-risk, high-reward business, and this annual report gives us a look under the hood for 2024. The headline, PRA Group says it was a transformational year. They expanded their leadership, doubled down in Europe, and tried to cut costs in the US. Let's see what's really happening and if that's true. Let's get to the numbers. First off, their portfolio purchases were up, meaning they bought more debt, about $1.4 billion. Their estimated remaining collections, or ERC, also increased to $7.5 billion. That sounds good. Cash collections, the money they actually brought in, also rose over 12% to $1.9 billion. Net income, that's the profit after expenses, they're reporting about $70.6 million. In 2023, they actually lost money. Diluted earnings per share, that's $1.79. So on the surface, things look like they have improved, but there's much more to the story. Where is the company focused? They have two major operations, core and insolvency. Core is their main operation, purchasing and collecting debt. Insolvency is purchasing debt from customers who are in bankruptcy or similar proceedings. They sell debts in spot sales, which are single portfolio transactions, or forward flow sales, which are purchases of multiple portfolios over time, typically from 6 to 12 months. Looking at the US, portfolio purchases jumped 40% in 2024 to about $795 million. PRA is saying there's plenty of debt available because people are using credit cards more and they're falling behind on payments. They want to refine collections and use work-from-home and offshore agencies to increase profit. Over in Europe, portfolio purchases are up a more modest 14% to just over $500 million. The company says its deep relationships with sellers is what helped them grow in Europe. They've got a partnership in Brazil, and they're expecting to sell their remaining stake in RCB Investimentos, a servicing company, and make a quick $25 million. This will not impact their majority ownership in their Brazilian investment funds, and they do not expect it will impact their existing operations or future portfolio investment opportunities in Brazil. Now the elephant in the room, government regulations. PRA Group is in the crosshairs of the Consumer Financial Protection Bureau, or CFPB. It's a big risk since the CFPB can slap them with fines, change how they do business, or even shut them down. Also, they have to follow the Fair Debt Collection Practices Act. This act has rules about how and when they can contact people. They have to comply with consumer data privacy laws such as GDPR. A lot is on their plate. Here's something interesting. On the employee side, their US business received the Safe Workplace certification. Ironic considering their business is centered around debt collection. They also seem focused on employee health, safety, and engagement. Alright, time for the scary stuff, risk factors. This is where the company lays out everything that could go wrong. Economic conditions. A prolonged economic downturn or volatility in the financial or credit markets could place financial pressure on and negatively affect the ability of consumers to pay their debts, which could adversely affect collections and the value of our receivable portfolios. They might not be able to buy enough debt at good prices. If they can't get their hands on enough cheap debt, they can't make money. PRA relies on third-party service providers. Any disruption or failure of these third parties to provide these services could adversely affect our business operations, financial condition, and reputation. A cybersecurity incident could seriously mess them up. Data breaches can lead to fines, lawsuits, and a damaged reputation. They use AI to find accounts with higher chances of paying. If that fails, they are in trouble. Operating in 18 countries creates international operation risk from changes in geopolitical conditions to currency exchange rate fluctuations, the potential of forced nationalization, and the potential damage to our reputation due to non-compliance with international and local laws. They might face trouble collecting debts due to laws and regulations. Investigations, reviews, or enforcement actions by governmental authorities may result in changes to our business practices, negatively impact our non-performing loan portfolio purchasing volume, make collection of non-performing loans more difficult, or expose us to the risk of fines, penalties, restitution payments, and litigation. Adverse changes in our credit ratings could have a negative impact on our business, results of operations, and financial condition. They use a lot of debt to fund their operations. This comes with its own set of problems. As of the end of 2024, they had about $3.3 billion in debt. Last but not least, let's check the governance section that describes management's responsibility over cybersecurity threats. We have Vikram A. Adil, President and Chief Executive Officer, and Rakesh Sehgal, Executive Vice President and Chief Financial Officer. The company has recently been busy issuing and repaying notes, with the end result being $1.3 billion senior notes outstanding. They mention a non-GAAP measure called Adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization. Basically, it's a way of showing earnings without some of the accounting complexities. Their Adjusted EBITDA is $1.1 billion. Finally, this report states that January 2, 2025, the company exercised its right to sell its interest in RCB Investimentos SA, a servicing company for non-performing loans in Brazil. So this is the end of that story. Now, what's my take on all this? PRA Group operates in a tough business. They profit from other people's misfortune, which leads to a lot of regulatory scrutiny. PRA is saying that the company made a profit in 2024, but is it really as good as it looks? Well, the company is operating a high debt load, so all of those future collections that they're counting on to be profitable are going to have to come in. They have to walk a very tight line between profitability and compliance. There are too many external factors beyond their control for me to feel secure with this investment. It is too risky with not enough upside. Proceed with caution. That's all for today's Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more deep dives into the world of finance.